Hi, and welcome to Brokenomics. This is the third in this series, and today we're going to be covering interest rates. We're going to be talking about the misdirection in money and about how the main tool of government and central bankers, the main lever, has become broken and the effects that that's going to have. So let's start from a very fundamental level about what interest rates are. Very simply, everything has a price, including money. And you can think of interest rates at the most fundamental level as being the price of money, which you can, well, not exactly buy it for, but you can rent it for that amount. So we're going to be looking at a topic that should be very simple. It should be quite straightforward to explain. It should be about a 5-minute presentation. But it's not going to be that because this has been so manipulated, especially over the last 40 or 50 years, that it's led to a huge amount of imbalances in the economy. And it is probably the primary source of instability and imbalance that we see today. All sorts of problems are as a result of this manipulation. And the main economic news that you're going to hear, if you hear any economic news at all, is what central banks or governments are doing with their interest rates, with their price of money. So it's become a major topic. And if you want to understand how broken our economics are, this is a central one to get your head around, and will be fundamental for some of the stuff when we start getting into real life examples and start talking about more the geopolitical angle. So, let's go back to basics again, talk about what interest rates are from a conceptual level. If you are more productive than you need to be, you produce an excess of money. Now, I know in our system, everything you do leads to money, but in most cases, you almost immediately exchange that money for mortgage payments or for your weekly shop or clothes or whatever it is. It's only when you are excessively productive that you're left with a surplus of money. And you're going to want it at some point in the future because you're going to want to retire, or maybe you're going to want to go on holiday or something like that. So you're going to want to take this excess of money that you have right now and you're going to want to push it into the future. And you can do that through loaning it to somebody. Now, of course, you want to make your money work for you. So you're going to want to get a return on that. And you're going to want to take the lowest risk that you possibly can for your money. So at that point, you should have a market for money develop. And this is a perfectly legitimate, sensible use of the banking industry if it was done correctly, which is essentially matching the lowest risk borrowers with the lowest risk preference lenders. And the interest rate, if this market is working properly, should give you information. If the interest rate you're being offered on a potential borrower is high, it should be telling you that there's additional risk attached with that. That's exactly the mechanism that has become broken. So let's start with an example that you might experience in your real life. Let's say you know these four characters. So you know Richard, Gary, Russell, and Simon. They're all friends of yours. And you're in the situation where you have excess funds to lend out. And your four mates come to you and they're offering you various rates. Now, Richard is very dependable. He's offering 4%, and you're looking and thinking, well, there's a very high chance I'm going to get my money back. He's only offering 4%, but you might go for that. That's a legitimate place on the risk curve. Gary, he's a very unreliable guy, and he's trying to get away with 4%. So you're not going to lend to him. He's outside of the sort of efficient risk frontier. Russell, now he's an average guy. He's not quite as dependable as Richard, but he is offering a higher rate. And so you're taking a bit more risk and you might go for that. And Simon, he is kind of unreliable, but then he's offering a much higher rate. And you can sort of pick where you fall on this chart. And it really does make a difference. So if you're earning a 4% return on your money, it's going to take you 18 years to double your money. Whereas if you move up to 6%, only a 2% difference, you'll double your money in 12 years instead of 18. It's quite a significant difference. And if you're prepared to take on much more risk with somebody like Simon, who's you getting a 9% return, you can double your money in only 8 years. So when this market is functioning properly and you have good information, the interest rate is telling you something, as long as you can spot, the Garys, which clearly shouldn't be on this menu at all, it's a perfectly functional market for money. It's classic banking. And this led to, the worldview that, perhaps our parents and grandparents had. There's the famous quote from Einstein, which is compound interest is the eighth wonder of the world. And you can understand why previous generations have thought this with this example. So we got an example of a 25-year-old. He invests £10,000 up front. He adds £100 a month to it. And all of this is compounding at 8% a year. And when he retires 40 years later at 65, he's only actually invested £58,000 into this savings vehicle, but he's got £500,000 out of it because he's benefited from that compound interest effect. And that was the world that your grandparents or your parents, if they were born in the sort of 30s or 40s, that's the sort of world that they were brought up on. A world in which saving really did work. So you'd think from this example, but this is perfectly straightforward, right? You invest and you compound and you benefit and then you retire wealthy, right? Straightforward. No, it doesn't work that way. Not anymore. And the reason it doesn't is because of what we covered in the last episode, which was inflation. So if you want to understand what rate you're really getting on your money, it's not simply the interest rate that you're earning. You need to subtract from that the inflation rate. Let's look at where we are today. So the official numbers for the UK is that our official interest rate is 3% and our inflation rate is 11.1. As I covered in the last video, I think the real inflation rate is much higher than that. But let's just go with the official rate for now. What that means is that you've actually experienced a negative real interest rate of 8.1%. So your money gets worth less, even if you're earning a 3% yield on it, your money becomes worth 8% less every year. So it's basically that story that we looked at just a moment ago, except in reverse. Except now instead of investing 58 and it being worth £500,000 40 years later, now you can invest the £500,000 and it will buy you 58 grand's worth of stuff today in whatever it is in the future. I mean, it will still be the number of pound notes will still be there. You'll still have a compound effect on the £500,000, but it just won't buy you much. In today's money, it will buy you about 60 grand's worth of stuff. So this whole narrative, which the modern banking system was predicated on, it's all become flipped upside down by this effect of these negative rates and how much this market has become broken. So how did we get into this situation? Well, it's because interest rates have for many years now been seen as the primary tool of governments and central banks to manage the economy. And it all starts with the official rate, the official interest rate, or the overnight rate. Now, the way this works is, of course, banks, they interact with each other all the time because you might write a check from your account at one branch and give it to somebody else to pay an invoice that they then pay into their account. So all the time the banks are interacting with each other. Money is moving around the system. It's also moving around countries as well at the same time. So banks will settle up with each other at some point, but because the money is constantly flowing, what they do is at the end of each day is they basically take a tally on where they are and they see who owes who what, and this changes all the time. And then they charge an overnight rate, which the central bank sets. So it's the overnight rate is effectively what we call the interest rates. In this country, it gets called the base rate. In the US, it's called, I believe, the federal funds rate. At the moment, it's 3%. That's not per night. That's an annualized rate, but it's the daily version of 3% annualized, and that becomes the basis for basically lending across the whole economy, because this is a very, very pervasive. It forms the crux of what we do. So your mortgage rate is probably based on base rate plus a little bit. If you're doing a business loan, it's quite common for the business loan to be expressed as base rate plus 0.5% or 1% or whatever it is. So we take our lead from this official rate. And it's the setting of this rate that has become, well, the quintessential tool of governments. And they actually like to think that they can steer the economy using this. And here's the idea: here's how they think it works. When economic activity is low, they lower interest rates. What that does is it makes it cheaper to borrow money, cheaper to go out and take a loan that you might then use to start a business or expand your factory or do something else. So cheap money is good for getting people to go off and do economic activity. And likewise, if they feel that the economy is running too hot, say there's too much inflation, or they just think things are getting ahead of themselves, they can raise interest rates, which makes borrowing money more expensive. Therefore, less economic activity happens. And also, as we covered with previous videos, the way that money is created in our system is essentially through loans and debt. So if inflation is looking high, you increase the cost of taking out a new loan, therefore less loans get taken out, and the idea is that it should rein back in on inflation. At least that's how it has worked in the past. So they feel that they can use it as a tool to manage the business cycle between booms and recessions, and they also feel that they can use it as a way to combat inflation. So where's the problem with that? The problem with that is that nobody ever thinks things are going too well, especially not politicians. We have a much better sense of when things are going badly. I mean, we know when things are in recession, we know when we're struggling a bit, but it's very unusual for politicians to decide that the economy is just a bit too good at the moment and they want to rein things in a bit and use this tool properly. And it wasn't even really helped when the central banks got their independence. That happened in 1997 in the UK, because central bankers, they live in the same world as us. They're subject to the same biases, the same sort of sentiment that is being pushed through the media. So again, like everybody else, they tend to understand when things are going badly. So the dropping of the rates, that tends to happen, but the other side of it, the raising, that rarely does. And what is essentially led to is interest rates getting walked down over time. So I'm going to oversimplify it here, but very basically, in the early 80s, interest rates were in the high teens. By the later by the later 80s, interest rates were in the low teens. By the early 90s, interest rates were now high single digits, and by the early 2000s, they were in the low single digits. And by 2008, the great financial crisis, and especially that period afterwards, interest rates hit zero. So it's often easy to forget how good it was in the past with banking accounts. So I'm going to show you a video now. This is an advert that went out in 1987. It was just a character, George Cole, who was a bit like a Del Boy, but not as well known. But he was well known at the time. And he's a wheeler dealer, and he goes off and he does all this stuff, and in the end, he just decides that it's easier sticking his money in the bank account. Watch this video, and you'll see what I mean.
Well, I'm trying to make a bob or two, but it couldn't have been much slower. When Batter Boy Bill from Muswell Hill said, "Psst, I've got a little goer." Meals on Wheels. He said, barbecues are all the rage, what every garden needs. If you've got the loot, you can have the lot. I was laughing all the way to the Leeds. I wonder where he got them. See, I got an account called Liquid Gold, and the Leeds don't mess about. If you need some cash out sharpish, those girls will dish it out. Speedy Leeds, I call them. Then a message came from heaven, saying, son, don't catch a cold. Your money's doing well in there. That's why they call it gold. So it's Leeds 1, Bill 0. I said, sorry, Bill, if I bought this lot, I'll be completely off my trolley. You can keep your flaming barbecues, and the Leeds can keep my lolly.
Liquid Gold now pays up to 8.75% for bigger savers, so laugh all the way to the Leeds.
Right, so did you catch that at the end? The interest rate that he could get by just walking into a high street bank was 8.75%. That's amazing. You don't get anything like that these days. So there was that strong incentive to save your money so that somebody else could then borrow it. That is genuine economic activity. people with excess saving it, getting a healthy return on their money. This was great if you were a retiree because you could work hard over your life and then you could put your money in the bank. You could get a nice return on it. You could live on that. So why do these interest rates get walked down over time? What's happening? What's the mechanism there? And it's essentially because governments and central banks, they're always reluctant to take the necessary medicine. So what should happen is you have your economic boom where things get a little bit carried away. And during that boom, businesses start doing things that aren't really viable. There's not really a strong market there. And government especially, when things are going well, they go and they just spend too much money. And what should happen in the corresponding bust period after this is that all of that needless excess should get washed out. So the businesses who are doing things that aren't really that viable should go out of business. And more importantly, all those government programs that they picked up in the good times when they thought they could afford it should cease. Should cease to happen and the program disappear.
To watch the full video, please become a premium member at lotuseaters.com.